Alright, so welcome back, guys. This is a new video. 3 stocks you need to buy this week, and you know the deal. We're gonna start off with the lowest risk stock, followed by the medium risk, and then finally finish off with the highest risk stock. So you know how it goes. I just want to note a few things this week. Is there any news? So just a few things to look out for this week. There is an FOMC meeting, so basically what that means is that the chair of the Fed is going to speak, and you know, depending on what he says, people are going to react in different ways. So just be on the lookout for that. You know, last time he spoke, he was basically saying, like, I'm not gonna raise interest rates till 2023. And then Wall Street was like, nah, you're capping, bro. You are gonna raise your interest rates because inflation is gonna, like, beat your ass. And he was like, nah, bro, I'm not gonna raise it till 2023. And that's why the markets were very volatile in late February, early March, because there was this big disparity between what Wall Street thought was going to happen and what the Fed had to say. So be on the lookout for that. He is going to speak. I don't know what he's going to say, but just be on the lookout for that. Alright, so the first stock I want to get into today is T-Mobile. Ticker symbol TMUS, and they are trading at about $131. So if we look at the chart, this is very close to their 52-week high, which was 135. They initially hit that back in January, and you know, they were part of that tech sell-off. So after going up to 135, they sold off. They were trading around that 115, 120 area in mid-February, late March. But I'm very bullish on this company, and I think the stock has recovered so well since that February low. The reasons are because their whole business model is to give consumers the cheapest plan with the most data available, as opposed to the competitors Verizon, which are typically the most expensive ones, and AT&T, which typically have their customers join a binding contract which doesn't let them leave. Verizon and T-Mobile, they don't do that. So there's a few reasons why I'm so bullish on T-Mobile. So last year in the spring, they merged with Sprint to become a superpower in the communication space. And this caused their revenue to grow by a lot. So in 2019, they had about $45 billion in revenue, and in 2020, they had $68 billion. Their price to sales right now is at about 2.2, and their price to earnings is about 44. So their price to earnings is a little high, but their revenue is growing substantially. Like I said, they merged with Sprint, so that really helped them. So if we look at their net income, which is basically what they have left after you subtract all the expenses from their sales, they only had about $3 billion, which was actually less than 2019. So I said their sales grew in 2020, so you would think that their net income would also grow in 2020, but that wasn't the case. Like I said, they're investing very heavily and aggressively into the 5G space, which is causing them to take a hit on earnings. But the low earnings is only temporary. They announced that they were entering into a partnership with YouTube TV. So you know how a lot of these companies, like Verizon, has Fios, and they offer their customers TV, Wi-Fi, phone service. AT&T has DirecTV, so they would offer them TV services through that. So T-Mobile also had something called TV Vision, which didn't really take off, which was kind of like their cable network offering. But they kind of just said, we're going to shut down TV Vision, and we're just going to offer our customers a cheaper price on YouTube TV. So I really like this move because people are moving away from that traditional cable network type of thing where, you know, you have a cable box and you have all these channels. People want streaming. They don't only want to stream Netflix and Disney Plus. They want to stream their favorite channels as well. So they're kind of starting to leave these traditional cable networks and move more towards like Hulu Premium, YouTube TV. What's the other one? So T-Mobile recognizes that, and now they are offering their customers a discounted package for YouTube if they add on YouTube TV. So YouTube TV is usually about $65. Now they're offering it to their customers for about $55 just for being a T-Mobile customer. And they're also trying to expand their home Wi-Fi services as well. So they want to be kind of like how Verizon Fios, they're very popular around the country and providing people with fast Wi-Fi in their homes. T-Mobile wants to provide a similar service as well. So this is why I'm not too worried about the price to earnings ratio, and I'm not too worried that they didn't do too well in their earnings back in 2020, because there's a reason why, and I think it's going to pay off for them. Telephone companies like Verizon, AT&T, and T-Mobile typically have a lot of debt because these are expensive businesses to run. Right now, where the stock is at, it's still below its all-time high. It's only valued at about 150 billion in comparison to their competitors, Verizon and AT&T, which are valued at over 200 billion. So I think there is room to grow for this company. I wouldn't be surprised if it would hit that $150 range by the end of the year, and I think in the future it can even hit $200. So the next stock I wanted to cover is Expedia. Ticker symbol EXP. This is a travel company. I'm sure many of you guys have used it before when you booked a flight or when you booked a hotel. So let's look at the chart, and the stock is trading today at about 176. Earlier this year, it hit a high of about 187, and then it sold off and it went back down to about 160, and now it's somewhere in the middle. I really like where the stock is at. It's still trading about that above the 50-day moving average, which is a very positive sign, and it's been trading above that 50-day moving average for a while now, really since May of last year when it recovered from the pandemic. Obviously, it got hit very hard when the coronavirus first occurred, travel stopped, all these types of stocks got hit very hard, but ever since then, it's stayed consistently above that 50-day moving average, which is a very bullish sign. But like I said, I don't really like to focus too much on price movements and charts. So let's look at their fundamentals. So the Expedia app allows you to do a bunch of different things like book a flight, book a hotel, rent a car. But what I also like about it is how it has its arms in a bunch of different areas. So it also owns other travel companies such as Travelocity, Hotels.com, Orbitz, and my favorite one is Vrbo. So if you haven't heard of Vrbo, what it is, it's Expedia's attempt to compete directly with Airbnb. So they allow customers to book home rentals, apartment rentals, and the difference is that Vrbo is more focused on providing customers with luxury homes, luxury apartments, and I think this is going to be a big competitive advantage for them against companies like Airbnb, because a lot of times with Airbnb, people complain that, their apartments weren't as nice as advertised, that the host didn't really do a good job of cleaning it up. And I can see how some apartments and some listings on Airbnb aren't consistent with what consumers were expecting. So Vrbo is very focused on providing customers with high quality experiences, and I think that this just complements Expedia's business very well. With travel demand increasing month by month as the world is beginning to reopen and get vaccinated, I see Expedia's business really growing this year and in the future. So if we look at their fundamentals, we see that last year they got a total revenue of about $5 billion. So this is a decrease from 2019, which was $12 billion, which we can expect because obviously, there was no traveling because of COVID. So $5 billion in sales for Expedia is very good, especially when you compare it to their valuation. So they're only valued at about $25 billion, $5 billion sales. That puts them at about a price of sales of about 5. Just to compare that with one of their competitors, Booking.com, Bookings is valued today at about $95 billion, but they only had $7 billion in sales last year. So this just comes to show how undervalued Expedia is in comparison to some of their top competitors. And like I said, in 2019, they had $12 billion in sales. So if you use 2019 sales, is only at a price of sales of about 2, which is very, very good. We can expect Expedia to grow this year. There's going to be a lot of demand. People want to travel all over the world. They want to travel to South America, they want to travel to Asia, Europe, all these different types of places. And they're going to use Expedia for that. I'm really bullish on this company. I don't know why. I just have a really good feeling about it. I don't know. Sometimes it's just a feeling. Like, they're just in so many different spaces in the travel industry that I just don't see how this company can fail. And I can easily see it going over $300 at some point. If not this year, then definitely next year. It's just so undervalued right now. And as earnings come in, they're set to report earnings in early May. I think the first week of May. So when that comes in, definitely keep an eye out for that. See how they're doing. I expect their earnings to be great this year. And yeah, I'm very bullish on the stock. I just have a feeling, guys. Sometimes you just need to believe in what you're investing in. Like, you really need to believe in the company that you're putting your money into. Okay, and the last stock I want to talk about today is NIO. So NIO is trading at about $39, and it is a luxury electric vehicle company from China. So let's look at the chart real quick. And if we look at the chart, we see that it got to about $67 back in mid-January, and that was around the time of NIO Day. So NIO Day, what it is, it's an annual event that the company does where they announce all types of new products. Since that $67 all-time high, they've gone back down to about $39, and right now I think it is at a very good spot. So what sets NIO apart from other EV manufacturers? So like I said, in January they had this whole NIO Day, and basically during NIO Day, not only do they announce new products, but they also have musicians, entertainers come in for the fans. So they're really trying to build this whole community and fan base around the brand, and it's really working for them. A lot of people in China love NIO. They want to buy NIOs instead of Teslas, and it really has to do with how NIO is marketing itself and really trying to establish itself as a leader in China. Also, they have this whole battery swap program, which is a game changer for electric vehicles. So with traditional vehicles, we have an engine that powers a car, and that really determines a lot of the performance within the car. With EVs, we have batteries, duh. But like these batteries, a lot of times we don't know how long they're gonna last. It's a lot like with your iPhone. When you first buy it, the first couple of months, the battery works great, but then after a few months, and maybe even after a year, you start to notice that the battery lasts less and less. So with EVs, a lot of customers have these same concerns. EVs haven't really been around that long, so we don't really know how long the battery is going to last. So what NIO has done to protect consumers from this risk is that they've announced a new battery swap program. So what they do is that they sell the cars without a battery, and it dramatically lowers the price of the car. So if we look at their ES6, they sell the ES6 for about $52,000, and without a battery, they sell it for about $39,000. So consumers are saving $13,000 right off the bat just with the battery swap program. And then NIO is basically providing them batteries through this subscription service. It's $200 a month, but customers get a new battery every time NIO releases a new battery. So let's say you buy a NIO today in April 2021, and then 6 months down the road, NIO releases a new battery. It's more powerful, more durable. They're going to swap that new battery into your car for no additional charge, just because you are part of that NIO battery swap program. So this is a huge advantage of buying a NIO, and it's going to be the reason why a lot of people buy NIOs over other electric vehicles. Now, one of the risks with this battery swap program is that we don't really know how it's going to affect NIO's finances. We don't know if it's going to be too expensive to operate this program, but for the time being, we know that it is going to attract a lot of new customers for them. Next, NIO is expanding to new markets. So they are expected to expand to Europe later this year. They're going to start selling their car in Norway, I believe. And that's really going to be the first step into NIO growing into a global brand. They are already growing within China. Last year, they sold about 44,000 vehicles. And this year, through the first 3 months, they've already sold half of that. So they're on pace to double the amount of vehicles they sold last year. And that brings me to my next point, their valuation. So right now, NIO is valued at about $60 billion. And last year, they had sales of about $2.5 billion. So that puts them at a price of sales of almost 30, which is very, very expensive. But if you take into account this year's sales, which is expected to be around $5 billion, that puts them at a price of sales of 14. It's still very expensive, even for a growth company, but with growth companies, we are expected to pay a little bit more, and that's why I have this as my riskiest stock. Because although it is at 39 right now, and it's already fallen 40% from that all-time high, that's why I think with NIO at this point, you should just buy a few shares. Like if you were planning to buy, let's say 100 shares, maybe only buy 40, maybe only buy 50, just in case it pops, because this is going to be a great company long term. You don't really have a lot of companies in the market that double their sales year over year, and NIO's on track to do that. The other risk with NIO is that they aren't profitable yet. I mean, we can expect this with the new company. They've only been around for 7 years, and it took Tesla over 10 years to become profitable. I'm not saying NIO's going to become Tesla, but we can see that these car companies, it's very expensive to operate them, so it takes them a lot more time to become profitable. I think they're on the right track though. They're doubling their sales every single year. They know what they're doing. They have a lot of fans. So I think right now NIO is easily a buy, but I wouldn't put all your chips into NIO right now. So there you have it, guys. Those are my 3 stocks for the week. T-Mobile, I think their company is doing very well, and they just seem to continue investing into the company to continue growing. Then Expedia, I think Expedia has a real opportunity to become a giant in the travel industry. And then finally NIO. I think NIO is on the right path for growth. But yeah, with that being said, thanks for watching, guys. Don't forget to hit that like button and subscribe. Share this with somebody if you liked the video, and I'm gonna see you guys next week.